When thinking about smartphones, it is almost certain that Apple comes to mind. However, as of recently, the company has also started branching out into different fields, which saw the company's share price jump quite a bit over the most recent years. But is Apple still valued at a fair price? Should you buy Apple in the current economic environment? And will the stock continue to do as well as it has been in the recent years? This is Might As Well Invest, becoming smart money. On a quick side note, the YouTube algorithm has recently stopped pushing my videos. So if you want to help me out with no additional cost whatsoever, I would appreciate it if you could smash the like button, drop a sub, and maybe even share your take on Apple in the comments down below. Apple, which was founded in 1977, is one of today's leading smartphone manufacturers, constantly competing with Samsung for the number one place. However, Apple is more than just smartphones, which is also represented in the company's market cap of about 2.04 trillion, thereby making it the biggest publicly traded company as of today. Since we however all know that this market cap does not come out of thin air, it is also safe to say that part of this valuation is to be attributed to Apple's revenue of about 274.5 billion in the last fiscal year. To also get a rough idea of what may drive Apple's revenue going forward, let's break that exact revenue down a little bit further. Generally speaking, Apple divides their revenue into 5 segments, which I broke down into 4. The biggest one of these is the iPhone segment, which managed to produce about 137.7 billion in revenue. This is then followed by the service segment with about 53.7 billion. Coming in the third place, we then have the Mac and iPad segment with about 52.3 billion. And last but not least, there is still the wearables, home and accessories segment, which contributes the missing 30.6 billion. But enough with the brief introduction. Let's get to the interesting part for all of those who already are shareholders or want to become such, and that are the distributions to shareholders. Apple currently returns capital to their shareholders through dividend and to some extent stock buybacks. However, let's at first take a look at the dividend, which currently sits at about 88 cents, equaling a current yield of 0.7%. Pair this with a dividend growth of 8 years, a 5-year growth rate of 9.41%, and you get a dividend that is not only stable, but also growing pretty reasonably. When it comes to stock buybacks, these are a little bit harder to track. However, it can be said that they sat at a pretty high 71.4 billion in the most recent fiscal year. But let's take an actual look at the numbers in order to see how sustainable these distributions are in the long run and whether we might even be able to observe a higher distributions growth in the future. First of all, we are able to observe a free cash flow that is growing pretty quickly, which is obviously a great thing. If we now put this into contrast with the distributions, we can see that these in the big picture seem borderline sustainable due to Apple spending a ton on share buybacks. As of now, I would however say that this is nothing major to worry about, but I would expect share buybacks to slow down in the long run in order for Apple to raise their dividends even further. However, let's also take a look at Apple's balance sheet in order to get a more detailed overview of their financial position. As per usual, let's start out with the year of 2016, in which Apple's total assets sat at about 321.6 billion US dollars. These were made up by about 128.2 billion in equity, 115.6 billion in financial debt, and 77.8 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is obviously done using Apple's debt and its cash position of about 20.4 billion, with which we get a net debt of about 95.2 billion. If we now compare this to the year of 2020, we can see an increase in total assets to about 323.8 billion, which were now made up by about 65.3 billion in equity, 112.4 billion in financial debt, and 146.1 billion in non-interest paying capital. Let's however again calculate the net debt, just like we did for the year of 2016, with this year's cash position of 38 billion. This time we get a net debt of 74.4 billion, which is a rather decent increase. But let's also find out how sustainable the debt of Apple actually is and whether the debt has gotten more or less sustainable. This is done using the EBITDA, which after some basic calculations leaves us with a sustainability factor of 1.35 for the year of 2016 and 0.96 for the year of 2020. This tells us that Apple's balance sheet is in a great position and that they could even go as far as to use more leverage. Alright, so since we now have the financials covered, what we want to do is get the margin of safety, as this will help us with getting the fair price per share for Apple. First of all, it has to be said that Apple is one of the innovative powerhouses of the tech industry that pushed multiple barriers quite a bit to the point where most of the stuff has become a new regular. Some examples for this are things such as smartphones, tablets, but also AirPods and smartwatches. While they didn't necessarily invent the tech behind all of that or came up with the idea, they still put them into the position they are in as of today. And that is also a trend which I personally see continuing through things such as, for example, the rumored EV car. However, we can also already see Apple's magic as an innovation powerhouse in regards to 5G, which saw rapid integration in their newest devices, making them become an almost instant success. Therefore, I will be reducing my margin of safety by about 10%. Reaching a status like this, where almost all of your products become an overnight success, is quite hard though. Therefore, I personally find it increasingly good what kind of status and level of consumer satisfaction Apple was able to reach with their ecosystem. One of the most recent highlights of these kind of developments is Apple's new take on customer privacy and the updates tied into it, which at least for me boost my overall confidence in the company even further. And you guys know how it goes. Happy customers come back to buy more of your products. Therefore, I will be reducing my margin of safety by another 10%. Last but not least, I also want to add that the business of Apple is pretty much what can be considered the new consumer staples of the future. With that I mean that the devices such as iPhones become a bigger and bigger part of our life, simply due to the fact that it makes our day easier, gives us ways to socially interact, and so on. And I mean, at the end of the day, would you stop buying phones in a recession? Sure, Apple is more on the higher end of the price spectrum, but with a tool this powerful that also acts as a social symbol, I highly doubt that this will be the thing that people save on. And at the end of the day, if we are honest, we are all kind of addicted to these devices anyways. Therefore, I will reduce my margin of safety by another 10%. However, I also want to disclose the one possible danger and therefore downside I personally see with an investment in Apple. And that is the possible danger of regulation by the government bodies across the globe. It is no secret that the regulatory bodies across the globe and big tech haven't been the biggest friends in the past, which quite often ended up resulting in big tech being fined. However, I want to add that a fine is one thing, but the possibility of breaking up the tech giants into tiny pieces, like it in the past has been done with AT&T and so on, is becoming more and more of a danger. Therefore, I will add 5% to my margin of safety as a measure of precaution. To now get the fair value of Apple, we have to take a look at the historic dividend yield. For the past 10 years, this set an average of 1.35%, thereby meaning you want to buy the stock if the yield is above that. To put it into numbers, with the current dividend of 88 cents, a fair price to pay would be $65.18 per share, which would mean with the current share price of $127.63, you would have to pay a 95.81% premium. Note, this is only in respect to the dividend though. If we would use a valuing method like the DCF, we would arrive at a fair value of about $143.80, which is in my opinion a little more accurate than the dividend analysis model for the tech company case. Usually we would now calculate the risk-adjusted fair price with our margin of safety. Since our margin of safety, however, came out to zero, we can just skip that part. To sum it all up, I think that Apple is probably one of the most well-rounded tech companies currently out there on the market. While it for sure faces some possible issues through regulation, I personally think the stock will continue to do just as well as it has had in the past. I personally also think the service segment will become an even bigger part of Apple's revenue in the future if they continue to innovate like they have in the past. Therefore, I would currently rate Apple a buy when using DCF, as the stock in my opinion currently provides still enormous upside for the future.